it's a cash flow problem. It's fundamentally a cash flow problem. You have your fiscal, which is basically your rupee returns and obligations, right? So your fiscal deficit is where your expenditure, government expenditure exceeds the government income. So ideally you should have a surplus. You should be generating more than you're paying. Then you have the dollar income and obligations. So the dollar income is a function of your exports and your imports. That's what is called the balance of trade. So usually your exports should be more than your imports, ideally. In our case, that's also a deficit, and that is to some extent counteracted by the remittance flows, tourism earnings, and the foreign direct investment. All those inflows against the outflows, again, there is a substantial deficit. So we have what is known as a structural issues, twin deficits, both on the fiscal side as well as the balance of payment side. So we need to address that, and it's not something new. I mean, this has been there for a very long time. There have been times where we had a surplus on our balance of payments a few times, but by and large, over a long period of time, we have had these twin deficits. In the last few years, we had the spate of issues associated with COVID, and for 2 or 3 years, again, our earnings were reduced considerably during that time. More recently, with certain government changes, you saw respite on taxes that made the situation even worse. So all these have caused this problem. So like any business, right? Ultimately, a government is also running a business of sorts, right? So you need to balance the books. So now the time has come where we've amassed so much debt, both on the rupee side, in the form of treasury bills and bonds from the banks, as well as on the dollar side, in terms of raising money in the international capital markets. And now we are unable to pay. Early during this year, after depreciating the currency significantly, we announced that we are going to be a preemptive default, which means that for the first time in the history of the country, we are unable to service our debt obligations. So then what happens is you become rated as a default country. So which means it takes you out from the ability to raise funds in the international capital market. So all this while we have been borrowing to service our debt. Now that is no longer there. So that has put a lot of strain on our reserves, and today we don't have any reserves. So only what we earn are we able to spend. And that's why there are these challenges right now in terms of shortages, not only in dollars, shortages on commodities, on essentials like fuel, gas, and you've had these black markets getting created, queues being created. So to get out of this problem, the only way is to get your cash flows in order, right? We need to figure out how we can make our rupee income against our expenses to be a surplus, and also our dollar income against our expenses to be a surplus. Easier said than done, right? Because the gaps are huge, right? So many sacrifices will have to be made, because all of us have been living in a welfare economy, right? All the things that we have taken for granted, right? Whether it's agriculture, the fertilizer, whether it's education, whether it's government hospitals, whether it's fuel, whether it's electricity, all of these are heavily subsidized. So who's paying for it? Ultimately, all of us are, right? And that's the debt. So now we have to get out of that welfare economy and be able to pay the real market prices. So that adjustment is what the IMF has come in here to support us in terms of, first of all, developing the right cash flows. That cash flows that will work both on the rupees as well as on the dollars, to build the country onto a sustainable path, and then to give us some money to help us tide us through that intervening period, and also to be able to access the international capital markets once again, for us to be able to borrow, hopefully lesser amounts, to be able to support us to take the economy going forward again. So that's fundamentally where the problem is. So the medicine is quite strong, right? So in the next 6 months, it is going to be tough. So cannot see economic growth this year, cannot see inflation, interest rates, the exchange rate correcting itself too much over the next 6 months of the year. And the positive thing would be that we will finalize the staff level agreement, IMF staff level agreement round about August, hopefully. And with that, there will be some respite. So there will be some funds coming in, close to about 800 to a billion, where the total repurposing, the bridging finance and some support from the multilaterals like the ADB will also come in to supplement that, and that will give us some respite. But if that money is going to be used to settle our short-term debt that we have borrowed from bilaterals like India and China, then that will not really help us much. But if that money is going to be utilized to bring the funds into the economy and to be able to help us sustain our purchase of essentials, then it will give us some support, and also it will also help manage the currency a little bit and also put less pressure on the interest rates. I think the most important thing that the policymakers needs to give to the country right now is confidence. There needs to be confidence in the sustainability of the country and the systems now start working again. Right now there is a big challenge, right? So you have to just look out of the window and you see queues, you see shortages, you see chaos. So we need to get out of that and create a culture where the essentials are plentiful, right? So that is where the IMF and all the bilaterals, multilaterals, this point in time needs to help us in supporting us to bring in that sense of normalcy. When that happens, then you will see a virtuous cycle starting to happen. Then you will have the confidence to bring the tourists back. People will be able to start bringing their monies overseas through the formal channels. Right now, we are not getting the full exporters bringing their money in. We are not seeing the remittances. Only about 40% of the remittance flows are coming into the country through formal channels. So when that happens, automatically your funding position improves, and then your ability to be able to meet your import obligations become better. So it's a virtuous cycle. And then also with that, if there can be some investment promotion and FDI start flowing into the country, that would be another huge advantage, because we need to, as a country, move from a services to a production-led economy, right? It's very important as a country that we drive the production-oriented industries. We drive our own Sri Lankan products, manufacturing, assembly, import substitution industries, and we move away from a trading nation that imports stuff that we directly sell without any value addition here. So that is the important focus from the policymakers' point of view. As a banker, I think there are very different ranges of business people. Many people here in this country are commodity importers, right? Which is a disappointing thing, right? So we need to move away from that. We cannot afford to be able to just import stuff from overseas and sell, whether it's vehicles, whether it's shoes, whether it's perfumes. We need to be able to bring in value addition. So those importers need to move towards value addition, whether it's manufacturing, assembly, import substitution type of industries, and then support the overall production capacity. And also we need to look at value added exports in terms of refrigeration equipment, warehousing, dehydration, and then bring in value addition and then be able to look at exporting these produce. There is a big transition there for businesses to do that, and as banks we have a role to play to support them in that journey. to guide them, give them the necessary finance, give them the necessary support to be able to give them the confidence to be able to start investing in ventures that can bring in that value addition. Then if you are an exporter, it's extremely important that you bring the money back into the country, because each businessman must stop thinking about their business in isolation. They need to think about the country. It's all the exporters who bring their funds together that make a big difference. Every cent of money that you leave overseas, that you don't bring back to the country, comes with a sacrifice that also affects your own business, because you will not be able to buy the raw materials, you will not be able to get uninterrupted supplies of utilities to be able to manage the business on a day-to-day basis. So it is extremely important to have that confidence to bring all your export proceeds back into the country. In the case of the normal citizens, it's important that you also become value-added people who share your labor with other countries, right? So as a country, we need to add a lot more value in terms of technical training, technical assistance, and send people with skills overseas. That way we get a bigger return when the funds come back into the country. So we need to move away from the culture of exporting housemaids to a culture where we send people as caregivers, as nurses, and there are institutions that are there for that, and we as a bank also are supporting these companies who are doing that. And as a result of that, you get a premium of maybe 100%, 200% on the salary or the wage that you get overseas, which means there is double or triple the amount of remittances that can come back to the country. Reducing the use of informal channels and getting people to get back into the formal channels to send this hard-earned money back to the country and invest back into the country is something that we need to really work on. And the government has a big role to play. The policymakers have a big role to play to give the right kind of sweeteners to make that happen. Because in the last 2-3 years, unfortunately, a lot of people swayed towards the informal sector. Now we need to change that. We need to get that back.